In short, yes, they can, and here is how. More than a year ago, I watched a video by Graham Stephan called "I spent $100,000 on a stock picking monkey." The whole premise of the video is that a monkey picking 10 random stocks could outperform the market. He said that he'll make an update in a year, and it's been over 13 months now, so I decided to see what would have happened if you bought 10 random stocks 1 year ago. But I wanted to know more, so I expanded the idea to see what would have happened if you had bought 50 random stocks and even 100 random stocks. I also made multiple lists with different parameters to see if the returns depend purely on luck or does luck play no part at all. I'll compare all the different results for the Graham Stephan's 10 random stocks, the S&P 500 and the NASDAQ index. So what is all this monkey business? It started in 1973 when Princeton University professor Burton Malkiel claimed in his best-selling book, A Random Walk Down Wall Street, that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Well, to see if that's true, I firstly made a list of 100 random stocks. I used a web page that generates random stocks. However, I did notice that it wasn't just stocks, it was also ETFs and bonds. I made the first list on January the 15th of 2022, so the stock market didn't drop yet. While I was doing that, I also removed any duplicates and stocks that didn't exist before January 15th of 2021. So the first list of 100 random stocks, ETFs and bonds would give you a year-over-year return of 9.06%. Okay, but does the yearly return change with the sample size? To check that, I made a separate list with just 10 random stocks, which had a lower return of just 4.69%, which made me wonder, what happens when you select 50 random stocks? Would the return be higher or lower? Well, surprisingly, this list would have given you the highest return yet. The return would be at 20.79%. While I was making the first three lists, I noticed something interesting. The stocks with the lowest return, or stocks that dropped the most, were mostly in three different sectors. And I think you can guess about which sectors I'm talking about. Pharmaceutical, biotechnology and healthcare companies. These companies greatly rely on government agencies approving their product, which results in the stock price rising by a huge amount, or in most cases dropping by 99%. So I decided to make another list without these stocks. I also excluded ETFs and bonds, and it seemed logically correct that this would give you a higher return. But quite strangely, the return was at 6.51%, which means that this list actually performed worse than the first one, and that surprised me quite a lot. But it also got me thinking, would the returns be way higher if just one pharmaceutical stock explodes? So I made another list of 100 random stocks, including healthcare, biotechnology and pharmaceutical stocks, and luckily among these stocks was one that had a return of 1,829.92%, which resulted in an overall staggering return of 27.54%. In the same period, the S&P 500 index rose by 23.47%, and the NASDAQ rose by 14.58%, which means that in this case the list of 100 random stocks outperformed the stock market. Okay, let's get back to the Graham Stephan. He chose 10 random stocks out of 1000 most valuable stocks. His list consisted Ford, Cerner, Align, Enel Americas, Republic Services, BlackRock, IHS Markit, Invitation Homes, Tesla and Netflix. And this list of stocks rose on average by just 1.93%. And even this was before the recent drop in the stock market, which is probably why he hasn't made an update. So among all this list of stocks, not a single list was negative, but this was, as I said, before the recent drop in the stock market. So naturally I had to check if all those lists of stocks had such great returns just because the market in general rose by so much in 2021, or does that have little to no influence? Because if the latter is the case, then this might be one of the best investing strategies out there. To check this, I made two lists of 100 random stocks. The first list consisted stocks, ETFs and bonds, and the second list contains 100 random stocks out of 1000 most valuable companies. The first list surprised me quite a lot as it had a yearly return of negative 8.32%, which made me believe that the second list isn't going to do that great either. But surprisingly, the second list of stocks had a yearly return of 15.01%. In the same period, the S&P 500 rose by 14.94% and the NASDAQ index rose by just 0.79%. So this list also outperformed the stock market and is one of the two lists that outperformed the stock market. So only 2 out of 7 lists outperformed the market and only one list was negative. On average, lists with 100 random stocks before the drop rose by 14.25%, and the 2 lists that I made after the drop rose by 3.35% on average. It's possible to beat the market with random stocks in 2 cases. We either get lucky and one stock explodes, or we pick 100 random stocks out of 1000 most valuable stocks. The latter is of course the safer option, and as we can see, luck also plays a part in this investing strategy. Because if you just select 100 random stocks and you get a lot of pharmaceutical companies and none of them explodes to the upside, it's very likely that the return is lower than expected, or in some cases even negative. But it also means that if just one of them explodes, your returns would be way higher, potentially even outperforming the stock market. And here comes the safer and in my opinion better option, picking 100 random stocks out of 1000 most valuable stocks. This method outperformed the NASDAQ index by far and the S&P 500 by a small amount. The amount of random stocks you select also plays a part. As we had seen, when I picked 100 random stocks out of 1000 most valuable stocks, I had a greater return than Graham's 10 stocks. So the more stocks you choose, the more similar the returns get to the S&P 500 index. Therefore, the more stocks you choose, the more stable the return should be. All in all, I think the safest way and the most rewarding way to choose 100 random stocks is by choosing from 1000 most valuable stocks. So 100 random stocks can outperform the stock market, but only in certain scenarios. It took me a long time to make this video, so if you enjoyed, it would help me out a lot if you liked and subscribed. If you have any questions or recommendations, leave them in the comments down below, and thanks for watching.